Operating an independent oil company on the Alaskan North Slope requires navigating one of the most hostile physical and financial environments on Earth. Extracting resources here means moving heavy equipment across frozen tundra and operating in sub-zero isolation. In this landscape, Pantheon Resources sits on a massive reserve. Independent audits confirm their Ahpun and Kodiak fields hold 1.6 billion barrels of liquids and 6.6 trillion cubic feet of associated natural gas. To monetize this gas, Pantheon signed a precedent agreement to supply 500 million cubic feet per day to the proposed Alaska LNG pipeline. The terms of this contract break corporate finance rules. Pantheon agreed to a maximum sale price of $1, while the Alaska LNG megaproject requires up to $55 billion. Compare that cap to standard rates. South Central Alaska faces double-digit prices for imported LNG. By capping their upside at $1, Pantheon appears to be leaving billions of potential revenue on the table, a significant loss for a pre-production independent operator that needs capital to drill wells. This discounted contract functions as a precision corporate finance maneuver. It is designed specifically to achieve the final investment decision on Pantheon's primary oil assets. However, this strategy is entirely dependent on external forces. Pantheon cannot monetize a single molecule of gas until the Alaska state legislature replaces the tax code governing midstream pipelines. The physical vehicle required to move North Slope gas to market is the Alaska LNG megaproject. Look at the scale of the pipeline infrastructure traversing this mountainous terrain. Phase 1 of this project is an 800-mile domestic pipeline designed to connect the North Slope to South Central Alaska. Building this conduit carries an estimated cost between $13 and $17 billion. The immediate demand for this pipeline is urgent. South Central Alaska, home to the state's primary population centers, relies on legacy natural gas reservoirs in the Cook Inlet, reservoirs that are rapidly depleting and creating an impending energy crisis. The lead developer tasked with solving this logistics problem is Glenfarne Group. Their mandate is to secure the private financing necessary to fund the pipeline's construction. Yet securing that multi-billion-dollar financing is currently blocked by the laws written inside the Alaska state capitol. The state's legacy property tax code stands as the primary barrier to private investment. This creates a strict dependency chain. Until the legislature acts, Glenfarne cannot finance the pipeline. And until the pipeline is built, Pantheon's natural gas remains trapped underground. To understand why this gas is trapped, we have to look at the subsurface geology of the Ahpun and Kodiak fields. The reservoirs contain liquid crude oil and volatile natural gas intermingled under high pressure, expanding and flowing violently upward together through the wellbore during extraction. This byproduct is called associated gas. When a drilling site lacks local consumer markets or export pipelines, this associated gas becomes entirely stranded. Operators cannot simply vent or flare billions of cubic feet of gas into the atmosphere. The mandated method for handling stranded associated gas requires building massive compressor stations at the surface to force the gas back underground, maintaining reservoir pressure. This schematic illustrates the financial drain of that requirement. The flow moves from the wellhead, through separation, into a high-powered compressor and back down a reinjection well. Over the lifespan of a field, continuously compressing and reinjecting 6.6 trillion cubic feet of gas incurs massive capital expenditures and constant operational costs. The alternative is to break this closed loop. If the gas is rerouted directly out of the separator and into an external third-party pipeline, like Phase 1 of Alaska LNG, the operator eliminates the massive cost of reinjection. Pantheon is specifically advantaged here. Their gas reserves contain very low carbon dioxide levels, meaning the gas requires almost no expensive chemical pretreatment before it enters a commercial pipeline. But without the Alaska LNG pipeline to take receipt of those volumes, Pantheon's massive natural gas reserve ceases to be an asset. It acts as a toxic liability, draining capital and suppressing the overall valuation of their primary liquid oil targets. Building the pipeline to relieve that liability carries its own severe financial friction. This historical heavy machinery laying pipe shows the massive labor-intensive upfront capital burn required long before a pipeline becomes operational. The friction originates from Alaska's legacy 1973 tax law, which applies a 2% ad valorem property tax to oil and gas infrastructure. Ad valorem translates to according to value. Under this system, the state and municipalities tax the assessed physical value of the infrastructure as it is being built. This exacts a toll based on the steel in the ground years before the pipeline generates a single dollar of revenue. This chart plots the construction timeline against cash flow. Applying a 2% tax on a $17 billion asset inserts a massive flat liability. It forces the developer to pay hundreds of millions of dollars in property taxes during the most financially vulnerable phase of construction. Watch the cumulative cash flow line. The upfront tax burden pushes the project deep into the negative zone, artificially extending the valley of death and pushing the break-even point decades into the future. This creates a commercial stalemate for Glenfarne. Institutional lenders will not underwrite billions in debt for Phase 1 when the project is saddled with these punitive early-year tax conditions. Because Glenfarne cannot secure the debt to build the pipe, Pantheon remains cut off from the market, freezing their upstream development. The traditional ad valorem property tax is structurally incompatible with modern megaproject financing. The math dictates that the pipeline will not be built without a legislative rewrite. The proposed legislative solution to this bottleneck is Alaska House Bill 381. The core mechanism of this bill is to completely replace the ad valorem property tax structure for the pipeline with an alternative volumetric tax, or AVT. Instead of taxing the assessed value of the steel in the ground, the AVT taxes the actual throughput of the gas, such as 20 cents per 1,000 cubic feet, as it moves through the completed pipeline. Crucially, the bill includes a built-in grace period. It provides a 5-year tax holiday, or delays the tax entirely until specific export-level volume thresholds are met. Look at the break-even matrix with this new structure. The massive upfront tax block is eliminated, replaced by a gradual, volume-scaling tax curve that only begins years after construction finishes and the revenue is actively flowing. Removing that upfront burden drastically reduces the total capital Glenfarne must borrow. The cash flow line rebounds upward, creating a visible zone of profitability that aligns with commercial lending requirements. This requires a strict political trade-off. Local municipalities along the route must forego massive upfront property taxes. In exchange, they receive a guaranteed $80 million impact fund during construction and a reliable share of long-term volumetric revenues. House Bill 381 aligns the state's tax collection with the pipeline's actual ability to generate cash. It provides the exact fiscal catalyst Glenfarne needs to secure final investment decision. This brings us back to the original paradox, Pantheon's willingness to cap their gas price at $1 per million British thermal units. Once House Bill 381 passes and Glenfarne finalizes their Phase 1 financing, Pantheon's precedent agreement automatically converts into a binding gas sales agreement. The terms of that agreement lock the state into a 20-year take-or-pay contract for 500 million cubic feet of gas per day. HB 381 enables Phase 1 financing, triggering a binding 20-year gas sales agreement. This take-or-pay contract guarantees Pantheon a multi-decade revenue stream. This revenue serves as ultimate collateral, unlocking the massive borrowing capacity needed to fund their oil extraction. Securing debt funding through guaranteed gas sales means Pantheon does not have to issue massive amounts of new stock. This protects their existing shareholders from severe equity dilution while covering their capital expenditures. The $1 discount functions as a strategic premium, securing the midstream infrastructure and debt required to extract 1.6 billion barrels of crude oil. The mechanics of this single contract ripple outward from Pantheon's balance sheet into the macroeconomic system of Alaska. The pipeline will carry natural gas from the Arctic isolation of the North Slope directly into the lit-up coastal grids of south-central Alaska. For the public, this physical connection averts an impending energy crisis. Local utilities receive a reliable supply of domestic gas, contracted below the volatile costs of foreign LNG imports. For the state treasury, substituting the ad valorem property tax for a volumetric tax removes the financing roadblock. This unlocks billions in new corporate taxes and state royalties that would otherwise remain permanently buried. The core lesson for energy analysts is clear. Raw geological potential is meaningless without midstream fiscal alignment. Alaska HB 381 provides the legislative mechanism to monetize a dormant geological liability and activate the state's next phase of industrial growth.